We'll get it going at 10:03. So, hey, I'll just start talking right now for everybody that's on there. So, for those of you that don't know me, Josh Chelsing, owner of PGS Home Loans, loan officer in the trenches every single day, trying to get home buyers into homes. And if you guys all know or have been part of transactions where insurance has either killed the deal or blown up the deal or caught the clients way off guard, insurance, it really is a crisis in the state of California. So I'm absolutely thrilled today to bring a guy that I've got a ton of respect for, Carlo Diaz. He is the owner of Old Harbor Insurance Brokerage up in Temecula, California. And before I pass it over to Carlo, a couple things I want to tell you guys, things you got to know about him, because Carlo is an amazing guy. He's got some of the best hobbies in the world. And I think there's a lot of people in this world that I'd like to spend more time with if I had more time, and Carlo is definitely one of them. He's got a phenomenal story about snorkeling in the middle of the night off of the coast, and then literally sharks bumping into him in the cold ocean as he's like going after lobster. He's got two kids that are amazing singers that are in nationwide contests, and loves mountain biking, snowboarding, dirt biking. Like, he's just a phenomenal guy. If you ever get a chance to talk to him, which I'd encourage all of you guys to do so, especially number one, send him business, because his insurance company is off the charts. His team is fantastic. His processes are fantastic. But he's just a phenomenal human being. So proud and happy to be able to call him a friend and tell him, someone that I count on for my business on the daily, which is awesome. So with that being said, I'm going to pass this thing over to Carlo Diaz. Listen up, you guys. He's got a great presentation. His knowledge is off the charts, and we all have a ton to learn from Carlo. So, Carlo, with that, please take it from here, sir, and you're on.
Wow, what an introduction. Thanks, Josh. I've got a lot to live up to, bro. And yeah, definitely. If anyone wants to go lobster diving, spearfishing, surfing, snowboarding, hit me up. I'd love to. And we could talk about insurance. Can you hear me okay?
Yep, we can hear you loud
Okay,
and clear.
great. And are we going to give people a little more time, or are we going to get after it right now?
Yeah, I think let's go ahead and get after it. People come on. I'll keep letting them in as they come in.
Okay, give me 1 second. Let me just get this going. How about the weather, right?
Yeah, it's conducive for fires.
Okay, and we're going to get this up. And we are okay. Can you guys see that okay?
Yeah, and you know what? Let's get that out of the way. Okay, good.
All right, you guys ready to roll?
Yes, sir.
Okay, so real quick before we jump into the presentation, thanks again, Josh, for the intro. I want to give you guys a little background about myself. We are an insurance brokerage. I'm one of the co-owners, the president of Old Harbor Insurance. And whenever you're getting education, whenever you're learning anything, it's so important to make sure that it's a credible source, right? And so, not as a flex, but as a testament to our relevancy. We're a brokerage and we close hundreds of escrows every single month. This is new business. And so we're licensed from Texas all the way west. We do the bulk of our business here in California. We're headquartered here in Temecula, California. So again, we're a brokerage, unlike a captive. A captive is like a farmer's or a state farm, good companies. But again, as a brokerage, we represent multiple companies. So we really have a ton of options for buyers. So again, it's important that you're being educated by a relevant source, right? If you are going to have a surgery, you want to make sure that you have the surgeon that's doing hundreds of surgeries a month, not the surgeon that's only doing 2 or 3 surgeries a year, right? And so, again, my hope is that we would earn your trust. We want to be a valuable resource for you and your teams, your clients, and we've got a full team here too. We're a great dynamic. We're not like a massive corporation, but we're not a small mom and pop. We're right in between, in the middle. We've got a big team, we've got systems, and a lot of great content. If you don't follow us already, check us out on Instagram. We're Old Harbor Insurance. We've got always posting relevant stuff. And then also too, check out our Google reviews. We've got over 900. I think we're at 912 as of last night. 5-star Google reviews, all 5 stars, and these are from real clients, real home buyers, real borrowers. And so again, a testament to our credibility, and we're in the trenches with you, running at your speed, at the speed of escrow. So with that, let's get into the presentation. So the California insurance crisis, right? And this is a true crisis in every word of the sense. It's been slowly developing over the last decade, but it's very much so volatile right now. And so today's agenda, I'm going to try to keep this to right around 40 minutes. We have a ton of information that I'm going to unpack. I want to pull all the layers of the onion back. And my goal is to just give you guys context and understanding so that you can be confident when you're talking to clients, or if you're a homeowner, be confident in knowing what's going on, because I think there's so much uncertainty, a lot of miscommunication, and it really makes us feel like victims almost in California. So my goal is to give you guys this information. And so again, we're going to talk about what's going on. We're going to talk about why it's happening, what to expect looking forward. And at the end of the presentation, you guys sit tight. We've got three super important, super timely talking points. And these are talking points that you can take to your audience, to your past clients, anyone that you've ever helped with real estate, and or even current clients too. And they're so critically important, these messages. And we've even diluted them down. We've created a script, so it's super easy for you to communicate. And Josh is going to share that with you guys at the end of the presentation. So with that, let's get after it. So what the heck is going on, right? We hear a lot of different
Not
things.
so weird, but I am weird, so.
All right, I heard someone's mic's on. All good. So what is going on? So we've all heard and probably experienced by now a lot of different elements. You know, historically, insurance is a very small piece of the real estate transaction, right? Critically important. You can't fund a loan without home insurance, but historically, it hasn't been a problem. Fast forward now to 2025, and it's out of control. So what's going on? First of all, like reading between the lines, like just being overt, insurance companies, they don't want to operate in California. Like they don't want to insure people. This is what we are seeing real time. We're seeing, here in California, we're governed. The insurance industry is governed by the Department of Insurance in Sacramento. And according to the Department of Insurance website, there's about 100 different insurance companies that are scheduled to offer home and auto insurance here in California. Of those 100 companies, over 80 have either said, nope, we're not writing any more new business, or they've left the state entirely, canceling all of their policies, right? So again, of the 100, we've had over 80 leave. So as you can imagine, that's creating a lot of gridlock with people that are not only shopping for new homes, but just California homeowners in general. Remaining companies, so the companies that are left, what we're seeing is they're incredibly critical of new clients that they're willing to insure, right? Historically, we can quote and bind a policy within an hour. Now they're wanting photos under the sink. They're wanting, photos of your circuit breakers. And good luck if you're working with a California Fair Plan, which we do, and we're going to do a deep dive on later in the presentation. But the California Fair Plan, they want your DNA, your blood sample. They want all kinds of stuff from you, right? And if you're a pre-existing homeowner, if you own a home already, if you've been grandfathered in, what we're seeing is many of those policies are now being canceled, right? Being non-renewed. We saw State Farm came out over the summer and they said, hey, we're going to cancel 72,000 home insurance policies. State Farm hasn't written a new home insurance policy since I think 2023, but now they're starting to cancel large swaths of their existing clients. So this is a true crisis in every sense of the word. And the last element of this volatility of the craziness is insurance costs are going up a ton. We've already seen it, right? Historically, home insurance would be right around $1,000. Maybe a little more, maybe a little less. Fast forward now, and we're talking, $3,000 for track homes. And if you're in a rural area, I mean, we're seeing some policies push over $20,000. So and this is a theme that's going to continue to over the next probably 2 years. And we're going to drill down on what that's going to look like specifically. So these are some of the elements of this volatility that we're talking about. Now, why is this happening, right? So I'll try to be quick about what caused this problem. But in a nutshell, it's a combination of two elements, right? It's this intersection. The first element is inflation, right? No surprise, as consumers, we're all feeling the effects of inflation. I took my wife to frozen yogurt a week ago, and we paid, just her and I, we paid $30 for 2 frozen yogurts. It's like wild, right? Now, as consumers, we often lose sight of the fact that these insurance companies are also being affected by inflation, right? So when you're talking about repairing a house because of a fire or maybe because of a water leak, these insurance companies are paying so much more for contractor costs, for building materials, for
Pero
all
kita
of these.
video.
For
Kita
all,
video.
hey guys, if you can, there you go. So again, the inflation is one element, right? Homeowners are, home insurers are paying so much more to repair homes. But a big element that, again, as consumers, that we really do lose track of is with auto insurance, right? They're also responsible for paying claims tied to the car insurance. And, I saw a statistic recently that the technology in our cars has increased more in the last 5 years than in the last 5 decades. That's nuts, right? Like every car now has backup sensors and cameras. And so you can't just simply have a body shop repair a car, right? A fender bender or a mechanic. You need to hire like a full IT team to recalibrate these sensors and the cameras. And this is additional burden, right? I mean, not even talking about the advent of the electric cars and their unique construction and technology, because that burden, that cost increases even more in regards to inflation. A last element in regards to inflation that is really contributing to this crisis that we're feeling is medical costs, right? These insurance companies are responsible if someone slips and falls at your house, or if you're involved in a car accident, they're responsible for that medical liability. And again, with that inflation rise, medical costs have gone through the roof, and legal costs too. So you've got this tremendous cost burden that historically was not as profound. And then you fast forward now to 2025, and again, we're all feeling it, and these insurance companies are no different. The second element that's really kind of contributing to this crisis is regulation. And so here in California, again, the Department of Insurance regulates the insurance industry. We're great at California, and I am optimistic, and I am still always pushing California, and we'll talk about why later in the presentation. But we're great at many things here in our state, right? And at the top of that is regulation. We're really good at over-regulating many industries. And so what I mean by that specifically, in how this has contributed to this insurance crisis, is back in 1988, the state of California, we passed Proposition 103, which regulation is good. But again, what this Prop 103 did was it limited these insurance companies that are operating here within the state of California, how much they could increase their insurance costs to us consumers, right? So as a consumer, I'm going, that's cool, right? I don't want these insurance companies just raising rates whenever they want. But again, you fast forward and you can see we're bumping down the road of history with relatively no problems. The maximum these insurance companies can increase the cost, again, tied to Prop 103, is 6.5%. So if they needed to increase costs for home insurance or auto insurance, the maximum the Department of Insurance would allow was 6.5%. If they needed more than that, then they would have to open like a formal request, and it's very lengthy. It takes years. Historically, it would take years for the Department of Insurance to review these rate increases. And also, it's very invasive. They would do like a full financial forensics review of these insurance companies. So again, we've been bumping down the road of history with relatively no problems. If an insurance company needed to take rate, they would either take that 6.5 or request and take that longer time period to get a higher amount. But you can see when we get to that post-COVID hyperinflation, right? The supply chain issues tied to COVID, that where everything just the cost of everything spiked so quickly in this intersection in time. It's like this perfect storm where they couldn't increase premiums fast enough for what they're paying out, the cost for all of these claims. And so a really unique quote that kind of sums up, let me see if I can move this, that sums up what's going on is, it says, without up-to-date insurance rates that reflect the true cost coverage, insurance companies are finding themselves facing significant financial strain. And so this is a true problem. Again, it's this intersection of inflation and their inability to increase prices fast enough. And so for perspective, just to give you guys some perspective, because I don't think most consumers understand how bad the problem is, Kemper Insurance, they're a huge national insurance company. We used to do a lot of business with them. They're completely going out of business, right? Countrywide, not just in California. And so they're closing down home, auto insurance, nothing. CSE Insurance, they've been around since the 1950s. They're civil servant employees. They historically insured firefighters, police officers. They are also completely going out of business, closing down. And so from the smaller mid-market companies like Kemper and CSE to the top of the food chain, State Farm is the largest insurance company in our country, so countrywide. And also State Farm is the largest insurer here in the state of California. and they're also not being spared. In California, State Farm has been profitable since the 1970s. Okay. You fast forward to 2022 and they posted their first net loss. It was 6.7 billion in losses, right? That was 2022. 2023, they followed it up with 6.4 billion. And so again, profitable to billions in losses. And that's right in line with that post-COVID timeline, right? That hyperinflation, paying out billions, they're hemorrhaging. And so this is an interesting statistic. In 2023, State Farm had its worst homeowners loss ratio in the last 20 years. The loss ratio is a number, a figure that insurance companies use to measure profitability. And basically, it's how much money they're taking in versus how much money they're paying out on claims. And so, meaning State Farm lost $1.17 for every dollar that they took in 2023. And this is only getting worse with the Los Angeles wildfires, too, in general. And so you can see it's an industry crisis, right? And it's not even so much that they're trying to be profitable. They're just trying to stay in business, right? And how can you stay in business when you're literally operating backwards, right? A total sinking ship. And so State Farm very much is on life support right now. Before we get into that, I want to give you guys a quick analogy. The example would be is if the DRE here in California said, hey, if you want to operate real estate in California, the maximum commission that you could charge is only $500. That's it. That's the maximum commission. But all of your costs to operate your real estate business are continuing to climb, right? Your marketing costs, your insurance costs, broker fees. It wouldn't really make sense to sell real estate in California when you can pivot out to Arizona or Nevada or Texas, other states that would allow you to charge your full commission. And basically, that's what we're seeing here with the insurance industry. Again, over 80 different companies have left. We've had insurance companies completely closed down and they are on life support. And so let's talk about this is recent news too with State Farm. And again, they are the largest home insurer in our state. They insure 20% of the homes here in California. And so just last Friday, February 14th, they basically asked the Department of Insurance for an emergency rate hike. So this is not, the formal process where they submit a request and it takes a long period of time. They're going, hey, because of the Los Angeles wildfires, we're trying to, we need an influx of cash. And so we need a 22% rate hike, which is wild. That's a big jump. The Department of Insurance, the insurance commissioner, basically turned him down. He said, we've gone to great lengths. The insurance commissioner said, we're not going to do it. This was on Friday. And this is State Farm. This is a scary element. They said, we've gone to great lengths to clearly answer the questions outlined by the commissioner. State Farm General must seriously consider its options within California insurance market going forward. So basically, what I'm seeing is they could potentially leave California altogether. Again, this is the largest insurance provider in California. So talking about compounding the problem, compounding the crisis, right? And what that would look like for the remaining companies and remaining outlets, right? If we're selling real estate, if we are needing to remarket our own personal home insurance, this could potentially create even more pressure to this problem. So kind of wild. And so I do think, historically, I wasn't talking about this third point, but I do think it's important. I think it's worth mentioning. It's just, to be fully transparent. I think that there is a third element that is basically tied to why this is happening. And basically it's mismanagement of the state regulators, right? And so I don't want to hammer on the regulators because regulation is important, right? I've got teenagers. If you have teenagers, you understand how important, right, oversight is in regulating, right? However, too much regulation in the first chance they get, our teenagers are going to boogie, they're going to leave the house, but too little oversight or regulation, and they're getting face tattoos and felonies. So what we need is that healthy balance, right? You need that healthy balance of regulation. But again, I do think that there was an element of mismanagement, specifically because the insurance industry had been communicating for over a decade some very important regulations that needed to be updated. Every insurance company they have on staff a team of actuaries. These are some of the smartest brains, literally like math doctors in the world. And these actuaries were communicating to the Department of Insurance, to all the state regulators saying, hey, this pattern is not working, and we're going to reach a point where it's going to create a crisis and it's going to break the system, right? And for over a decade, especially for the last 5 years, they've kind of been going back and forth. And I think that they definitely made a misstep, and there should have been some give. So I think mismanagement needs to be referenced. This is kind of a relevant quote that I pulled from a recent article. It said the California insurance crisis could have been mitigated, so it couldn't have been avoided, right? Post-COVID, hyperinflation, supply chain problems, none of that could have been avoided. It was unforeseeable, but it could have been mitigated. It could have been minimized, right? The crisis that we're feeling right now. Had regulators acted sooner, logical rate adjustments, updated wildfire regulations, and reinsurance reforms could have stabilized the market. Instead of years of delayed action and rigid policies, created the perfect storm, now forcing urgent reform. And so basically, the Department of Insurance was forced to address this problem. Last year, Gavin Newsom required Ricardo Lara, the insurance commissioner, to basically fix the problem. This crisis has been spiraling really bad for the last 2 years, and we've had the real estate industry, we've had the mortgage industry lobbying in Sacramento alongside the insurance industry saying, hey, we need help. You know, you've got home builders like D.R. Horton and Lennar going, we have a housing crisis in California and we can't sell these homes because no one is willing to insure them. And so again, they were forced to react. And so it's kind of a better late than never. And this is a little bit of light at the end of the tunnel optimism. So basically, in December, the Department of Insurance, Ricardo Lara, the commissioner, he came out with the Sustainable Insurance Reform Act to improve the California market conditions. And so again, this is our path to stability. And I'm confident that over the next year and a half to 2 years, that as Californians, that will start to feel some relief. So basically, what this bill included, this bill that just passed in December, right before the Los Angeles wildfires that we'll touch on in a second. Basically, the three main points is historical catastrophic rating. Okay, so most other states other than California, Florida, Texas, they allow insurance companies to provide historical catastrophic rating. Prior to this bill, this reform, the state of California didn't. They basically viewed it as unfair. And what it is areas that experience historical catastrophic loss, like Paradise, California, where the entire town burned down, right? Or now, the Palisades area. Insurance companies were not allowed to charge a high fire premium in those areas. They had to basically keep costs more balanced. And so during this time period, you can imagine if you're operating a business in California and you were unable to charge a premium for higher risk areas, properties, you would have to increase the cost for other areas, right? Maybe San Diego or Orange County would have to be brought up to offset the cost for these higher demand areas. This is one of the changes. And this is one of the requests that the actuaries were communicating to the Department of Insurance over the last 5 years. Hey, we need historical catastrophic rating. And so this has happened. Again, this is kind of a pathway to stabilization. The second, and critically important, is reinsurance. Again, this is another element that many other states, but California, allowed these insurance companies to charge reinsurance costs to us as consumers, to us homeowners. And basically what reinsurance is every insurance company in our country, they use in some capacity reinsurance. And so what that is we'll use State Farm again as an example. State Farm doesn't hold all of the risk on their balance sheets, right, on their paper, because if there was a massive catastrophe, that could render them insolvent, right, like we're facing with the California Fair Plan in their losses. And so basically companies like State Farm, they say, hey, reinsurance companies, take 20 or 30% of this risk off of our balance sheets, right? And they have to pay the reinsurance companies to take that risk. And so if there's a catastrophe, State Farm will pay a portion, the reinsurance will pay a portion, and they're able to operate, and they won't be, again, rendered insolvent or go bankrupt because they run out of money paying out for these claims. And so this change in the reform, other states, Department of Insurance would allow these insurance company to charge us consumers a portion of that reinsurance cost. And why it's important and why it also compounded the California insurance crisis is because over the last few years, as claims increased, right, the cost of claims, we talked about the inflation element, the reinsurance companies, they're also paying out more and they're seeing the costs go up. So they're saying, okay, State Farm, if you want us to take 20 or 30% of this risk off your books. Instead of 1 billion, you're going to have to pay us 2 billion this year. And these insurance companies, again, had their basically hands tied, right? They couldn't offset that increased cost anywhere. They would have to eat it, plus the inflation that they were paying, plus they couldn't increase costs. And so again, this is an element of why these companies are in such poor financial condition in the state of California. Again, bright side, with this new reform, the Department of Insurance said, okay, we're going to allow insurance companies operating in the state to charge the consumers a portion of that reinsurance cost. So yes, I'm a homeowner. As a consumer, at first earshot, paying more for this reinsurance, it doesn't sound good, right? I don't want to have to pay more if I don't have to. But understanding that this is required to balance, right, this insurance marketplace and bring stability, I understand, and it's required, right? And again, when we reach stabilization, if we can create an environment here in California that's optimal for these insurance companies to come back and operate, that will naturally suppress costs, right? Just capitalism 101. When there's multiple insurance companies fighting for our business, that'll naturally suppress pricing. Right now, we're literally the adverse effects of that. There's very few insurance companies operating, and it's a very hostile environment for us as consumers. So these are big items that have just changed. And again, as they continue to pick up traction, it should stabilize the insurance marketplace. The last element of this new reform is they said, hey, we're gonna improve the rate filing and procedure timeline. So again, I had referenced that Prop 103, if they needed more than 6.5%, it was a long process. It took a lot of time and it was very invasive. They are working on streamlining that to speed up the process. And so again, I am confident that over the next few years that we are going to feel that stabilization here in California. And I'm optimistic. I tell our clients all the time here at Old Harbor and our referral partners that California is still the best state, right? We're the most populated. There's 40 million people that live here. We're the most populated state. And so there's always going to be a demand for real estate mortgage insurance services. It's just a matter of, taking these pieces of this problem, putting them together and reaching stabilization. And it's going to happen, guys. Also, too, if you're in the industry right now, volatility creates opportunity, right? So there's tons of opportunity. So what to expect looking forward? So currently we're going to see continued contraction, right? After the Los Angeles wildfire, a lot of these companies that were still here operating in California, now they have this massive cost burden where they're paying out for all of the claims, right? And so what we're seeing is, Mercury Insurance, they're great. They're A-rated. They're headquartered here in Orange County. They're one of the many companies that we represent at Old Harbor. And so prior to the Los Angeles wildfire, we were able to write home insurance with relative ease. After the Los Angeles wildfire, not only did they close many zip codes, but now if you want home insurance with Mercury, you have to. It's a requirement. Bundle your auto insurance with Mercury. So we're going to see this theme kind of moving forward, this continued contraction. Also, what we're seeing is this kind of continued shift from admitted to non-admitted insurance companies. And so basically, an admitted insurance company is a company that's regulated by the Department of Insurance. These are all your big box companies like, Mercury, Nationwide, Geico, Farmer, State Farm. And so non-admitted insurance companies, they've been around forever. However, we've only used them for harder to insure properties that none of the admitted insurance companies would insure. So like Big Bear or Lake Tahoe, we would use non-admitted insurance products. And so again, because they're not regulated by the Department of Insurance, they can charge more, right? They don't have those handcuffs on cost handcuffs. But they don't have the oversight, right? We were talking about that balance of oversight. There's no oversight for non-admitted or limited oversight. And so again, if you can, always choose an admitted insurance company. And when we're quoting homes, right, we're quoting throughout and we're always going to present the best option for the client. But what we're seeing is that no admitted insurance companies want to insure in California. And we're seeing this massive increase in non-admitted insurance companies. And these non-admitted insurance companies, and this is important if you're a realtor too, because we're going to have clients going like, I never heard of that company or I've never heard of this company. These companies are very strong, financially strong. They're oftentimes large international entities like Lloyd's of London or Scottsdale Insurance, and they've been around for years. And oftentimes these non-admitted insurance companies are even more financially sound than the admitted insurance companies. So they're great options. They're not bad, especially in this crisis. And here at Old Harbor, one of our highlights is that we're constantly bringing on new companies, right? We represent a ton of admitted companies, and we're constantly vetting and bringing in new non-admitted companies too. We want to have a ton of options for our clients. And so again, we're going to see this continued theme with like lesser known insurance companies, but again, they're great options. These are companies like Bamboo Insurance. You may have seen them on your transactions. And what we've seen too is a lot of companies that have left California, admitted insurance carriers, coming back with a non-admitted mask on, right? So they know what they're doing, and they're not bad options. Our hope is that when we reach stabilization, we'll have a ton of admitted options, because the admitted insurance companies are typically, better cost, right? They're more affordable, they're more comprehensive in coverage. But again, this continued theme of admitted to non-admitted is what we'll continue to see for the next year and a half. And then obviously the California Fair Plan. This is a wild element too of this insurance crisis. And so let's take a few seconds and do a little deep dive on the California Fair Plan, because we've all seen over the last year, right? Many of our clients have to use the California Fair Plan. And so basically the California Fair Plan, this is not new. It's not new to us right now. They've been around since the 60s, and they were basically spun up. The state spun them up as a result of the Watts riots. No one wanted to insure in some of these volatile areas. And there was also some brush fires in the late 60s as well. And so basically what it is it's the insurance product of last resort. If no one is willing to insure you, then the California Fair Plan will take you. And it's fire only, right? And so many people don't know that the only peril, the only coverage that it provides is fire. You have to pair the California Fair Plan with what's called a DIC, or difference in condition policy. That DIC, it covers all the other perils other than fire. So wind, water damage, theft, liability. And so it's the two policies together that create one traditional policy. But as you can imagine, two policies, that's double the cost, right? And so if we are working with, tight loan to value, it's just not an optimal option, right? And they're difficult, they're antiquated. We saw over the last summer that they were taking up to a month, right, to underwrite these policies. And it was creating significant gridlock with our transactions. We would have some lenders have to relock, right, loans because the California Fair Plan was taking so long. So again, I want everyone to understand kind of the theme of it. It's a great option, but it's last resort. It was never designed to be a competitive, viable home insurance option. It's supposed to be a temporary option. And even if you're a client and you purchase the California Fair Plan, there is a disclaimer that says you were unable to secure coverage anywhere else, right? And so it really is a last resort. And so what the California Fair Plan is, it's not taxpayers, right? It's not funded by the taxpayers. It's not even an insurance company. It's a conglomerate of the admitted insurance companies. And so let's see here, no taxpayer funding. Their Fair Plan is a syndicate. It's basically an insurance pool, right? So it's this bucket. And basically it's comprised, and this is important, and this is why these fires in the current crisis are compounding the problem, is that these admitted insurance companies that we keep talking about, right? We've had, over 80 out of the 100 leave California. These admitted insurance companies, the companies that are regulated by the Department of Insurance, they're responsible for funding the California Fair Plan, right? So that's how this is comprised. And so you can imagine that as these companies leave California, that it's creating more burden for the companies that are left here, right? Talk about compounding this problem, right, for these companies. And so basically, the losses are paid out. These insurance companies that are still here in California, it's paid out in direct proportion to the members' share of business written in the state, right? And so again, as companies leave, that creates even heavier burden. So we talked about State Farm. They've got 20% of the homes in the state of California. So that means that they've got, 20% of the balance that they need to pay for this Fair Plan loss. And why it's a problem, why this is again compounding such a significant issue, is that with the recent Los Angeles wildfires, right? The California Fair Plan, they insured a majority of those homes up there. And so the thing is, they only had about 300 million liquid to pay out for the claims. but they're facing billions in losses, right? And so there's this massive shortage, right? Specifically tied to the Los Angeles fires, right? And so this is new information. This is within the last couple months. And so basically, um, the California Fair Plan, if there's ever a shortage, like we're clearly facing a shortage after the Los Angeles wildfires, the Department of Insurance said, hey, California Fair Plan, you can send a bill, you can assess, right, those admitted insurance companies, the members basically that fund the Fair Plan, up to $1 billion in a calendar year, or $2 billion if they factor in commercial, right, losses. 1 second, guys. I'm just getting over that nasty cold that's been going around. It's like, man, taking like a week to kick. Anyway, so the California Fair Plan can send a bill. They can assess these admitted insurance companies that are still here in the state up to $2 billion in a calendar year. The kicker, and again, this is new, member companies, they can now send supplemental bills to us insureds, okay? Even if we had nothing to do with that Los Angeles fire. And what's interesting is they just updated the option for insurance companies to supplement us consumers in September, I think it was. So just a few months before the wildfires, which is wild to me. No pun intended. And so basically what that means is my house is insured with Nationwide. Nationwide is not writing any new business here in California, but they are renewing, right, the grandfathered policies. And so they have exposure in California. I'm not sure what percentage their exposure is, but now they're responsible for paying that shortage, right? The California Fair Plan shortage. And so now they are going to get a bill for $1 billion from the California Fair Plan, and Nationwide is going to send me, Carlo, a supplemental bill that I'm now going to be responsible for paying. Very similar to our supplemental tax bills, right, that we get randomly, and it's an extra $1,000. And so the Department of Insurance, they just came out last week and said, hey, yeah, this is happening. It wasn't sure that they were going to pull the lever, right, because the Fair Plan had this shortage, right? They only had 300 million. There's billions in losses. The Department of Insurance, the state, was actually talking about selling municipal bonds. And I thought that was the way that they were going to go, basically sell bonds and use the proceeds from the sale of the bonds to pay for the shortage, right, of the LA fires. In my opinion, this would have been a better option because the burden is spread out over all of the taxpayers in the state, right? There's more taxpayers than there are insureds, right? And they decided to go this route, right? Because there's less insureds than there are taxpayers in California, so we're going to be responsible for paying that shortfall, which sucks. But this is what the Department of Insurance just came out with, and they said what we can expect to pay on these supplemental bills, it's basically going to be a percentage of our premiums on our home insurance. So I don't know what that's going to math out to, but I'll keep you guys posted. We're always posting in the stories updates to the Department of Insurance shares, but this is wild. So you guys can see how even though the California Fair Plan, we use them often, but it's really compounding this problem, right? Because it's creating more responsibility for these insurance companies. And so again, the Fair Plan can assess these companies up to 2 billion, right? Factoring in commercial, but we're talking there's like 40 billion in losses, right? Someone that's going to have to come from somewhere, and these insurance companies and their reinsurance companies are going to have to pay for it too. So it very much is a crisis. I am confident that as we continue to move past the timeline of the LA wildfires, that the bill that was passed to loosen the regulation, the 3 points that we talked about, the cat rating, the increased reinsurance, and then also the timeline, that's what we need, and we just need time for that to pick up traction. And basically the Los Angeles wildfires, what this did was created a speed bump, right? I was hoping we'd reach stabilization faster. The LA fires are just a speed bump. So, but we're going to get there. Stay optimistic. So what else can we expect looking forward, right? Contraction, admitted and not admitted, the California Fair Plan. We're going to see continued use. And what we're going to see is continued rate increases. Boo, right? We're all seeing prices go up. But basically, these insurance companies, they need to balance, right, what they're paying out versus what they're bringing in. And so, like the analogy that I've been using with a lot of our clients here at Old Harbor, because it's not fun to talk about insurance costs going up, right? when we're processing real estate transactions, that's a huge factor, right? We need to know what the potential cost for home insurance is to see if we even qualify, right? And so the concept that I share with my clients is that, you know, here in California, our insurance costs what we pay for home and auto insurance. It's on the same cost plane as states like Utah and Idaho, right? Which is that's not balanced because we've got way more exposure here in California. There's way more people living here. I think they're just over 1 million in population in Idaho. We're 40 million in California. So that means more accidents, more fires. We've got more natural disasters here in California. So there's no way that our costs should be relevant to states like Utah and Idaho. I think what we're going to see and what we can expect is states like Florida and states like Texas that have consistent natural disasters. And you see homes like in Miami, and if you're on the water, you're going to be paying, right? Like 10 grand, $15,000 for home insurance or higher because you're that front line. You know, it's not as expensive as you move into the state. And the same thing with Texas. They've got hurricanes in the south, in tornadoes, in hail in the north. And I think the concept again that it doesn't feel good, but it definitely makes sense is that here in California, you know, I've only flown in first class one time, and that was on my honeymoon. And I typically fly coach. First class, it was killer, right? Like we went to Bali, the surf was great in Bali, but you know, you had a ton of amenities when you're flying in first class. You can recline the seat, you've got a blanket, you know, there's killer service. And so honestly, guys, like California, we are the first class of the United States. We are the best state by far. And trust me, I'm sure many of you have, and myself included, have looked at moving out of California, but we have literally the most amenities like first class. We've got the best weather. We've got the world's fourth largest GDP, even with companies leaving and people leaving. And so we've got the best entertainment options. We've got the best food options. I've got many friends and clients that have moved out of California, and that's one of their top complaints is there's no food options. Like it's not comprehensive. They've got like 3 like options, and they all close at like 5:30. And so again, these are elements that as Californians that we lose track of. And we've talked about paying a premium to live here in California, and now it very much is becoming more tangible, right? And so again, it is that concept of if we're going to live in the first class state, we need to start paying first class fees, right? And so again, right now we're still on that coach plane, and that is gonna, you know, it's not, it doesn't make sense. It's not sustainable for these insurance companies. You know, look at in San Diego County from 2018 to 2024, the median home price in San Diego rose by 57.6%, right? We've all seen it from 2018. And so why shouldn't the insurance products that's designed to protect these homes also be allowed to increase as well? Again, no one wants to pay more. I don't want to pay more, but we need it to make sense in order to reach that stabilization. So, I've got a couple final points, and then we're going to go over those client talking points. The final points being homes titled to a trust, right? These are some of the hot topics that we see on social media now. And oh, if your home is titled to a trust, get it updated. And so I want to basically kind of pull back the veil because there's a lot of miscommunication. And so, yes, if your home is titled to your trust, your home insurance needs to be updated, right, to reflect that legal owner of the home. But it's not gonna predicate if coverage is eligible, right? Insurance companies are good for the most part, right? And it's very common to buy a house in your personal name, and then over years of owning it, that you add a trust. And so insurance companies understand that sometimes homeowners forget to update, right, the home insurance to reflect the trust. And so it's not in the spirit of declining claims. It is literally if they're cutting a check, let's say if there's a total loss, that insurance policy, that check has to be paid out to the titled owner, to the correct owner. So what we're seeing is, they're processing endorsements. You've got to wait for that insurance policy to reflect the correct owner. It's not in the spirit of not wanting to pay. That's miscommunication. It's got to be done correctly, right? And so the only time where I have seen insurance companies leverage that trust to not pay is in extreme overt fraudulence, right? Like insurance fraud. I saw over the last couple of years, there was a client who was trying to process insurance fraud, and the insurance company said, oh, nope, the trust is, not the correct owner, so we're going to decline the claim. And so again, these companies are good companies. They're A-rated, they're regulated. They're not just going to deny a claim because of a trust not being titled correctly. But it's important to remind your clients to get that updated. Second talking point, can my insurance company cancel me whenever, right? We've seen after the Los Angeles fires, oh my goodness, they were canceling people right before the fire. And it's like, first of all, just because you got canceled, that doesn't mean that you can't replace coverage, right? Again, we're writing hundreds of policies every single month. There are alternative options. Also, too, in California, in order for an insurance company to cancel a policy, they need to provide 3 to 6 months heads up written notice, right? So there is an element of accountability that as homeowners, we need to be making sure that we're aware of too. So again, that's misinformation. Insurance companies can't cancel you because they feel like it. They've got to give you written notice. And again, just because you're canceled, that doesn't mean that you can't replace coverage. Is it optimal? Is it something that we want to be doing? No. And we tell our clients oftentimes, if you can preserve what you have, that's often going to be the best option for you. So Farmers Insurance, we're seeing that they're requiring now automatic water shutoff valves, right, for homes. I don't know if any of you guys have experienced this, but we're telling our clients, get it, right? It's $800 to $900 to install that shutoff valve, but it's preserving a great policy, great coverage with a great company, right? And so again, no, they can't just cancel you randomly. Moratorium. This is something that I wanted to be clear of. So after the Los Angeles wildfires, the insurance commissioner came out and he said, hey, we've issued a 1-year moratorium, right? So insurance companies can't cancel you because of the wildfire. But what's important to note is the moratorium only applies to homes affected in the adjacent of the wildfire, right? We have a link on our website, and you could pop in your zip code to see if you're eligible or not. But it's very much a minority of homes in California that are eligible for the moratorium. The majority of us California homeowners, the moratorium doesn't apply. And so this is critically important because if your insurance company sends you a non-renewal notice, you need to take it serious and be proactive and work on replacing that coverage before that policy lapses, right? So there is a moratorium, but it only applies to zip codes around the wildfire areas. Okay, we're going to go over these talking points, and at the end, I'll open it up for just a few questions. So these are the valuable talking points. Again, Josh has the PDF that he'll be emailing to you guys. All of my contact information is on that PDF form. So if you'd like help with clients, all of our website information, contact information, it's on that form as well. So the first talking point, this is super, super important. We talked about how just straight up insurance companies are not wanting to insure people. They're looking for reasons to non-renew people. And so the majority of California homeowners, they have their home insurance tied in with the mortgage, right? The impound account, right? The mortgage company pays for the property taxes and your home insurance, and they just divide it equally into your monthly mortgage payment. And so what we're seeing is very common that if you take out a mortgage and maybe the initial mortgage company is United Wholesale, UWM, it's very common that these loans are sold or issued to new servicers, right? You've got Mr. Cooper or PennyMac. And so what happens is these new servicing companies will send us homeowners a letter in the mail saying, hey, we're Mr. Cooper. We are now servicing your loan. Set up an online account, right, with Mr. Cooper to make your mortgage payment. And on that notice, in somewhere on there, it says also notify your home insurance who we are, have them update the policy. In just human nature, I'm guilty of it too. I get that notice and I'll set up my online account with, PennyMac or whoever. I crumple it up and I throw it in the trash. And the problem is, as my home insurance comes up for renewal, they're going to send that renewal notice to United Wholesale Mortgage, who's not going to care nor pay it. And that policy is going to go unpaid and it's going to lapse. Historically, insurance companies would provide a grace period, right? And if you get the payment back in, they'll reinstate coverage. Now, again, they're trying to get off the risk. So they're going, sorry, can't help you. And so this is super important in terms of preservation of that current policy, is to advise your clients to just, all you got to do is make sure, take a look at your home insurance policy. You can ask your current agent for a copy of it. And your mortgage company is listed. It's called a mortgagee clause on your home insurance policy. Just make sure that that company is the same company that you're making your monthly mortgage payment to. Again, Josh is going to have the script, so where you could just literally read off the script and it's gonna be great. The second point is we saw this with the recent Los Angeles wildfires, it being underinsured. On the script, we advise touching base with your clients just to make sure they have proper dwelling coverage. So home insurance, it doesn't insure the real estate value. Real estate values fluctuate. Home insurance insures the cost to rebuild, reconstruction value. And basically every insurance company, they have an internal calculator. And so as we're quoting the insurance, you put in like the year built, the quality of the construction. You can get most of the information from Zillow, if it's got solar or not, and it'll calculate the cost to rebuild. Now, because of this hyperinflation that we're experiencing, oftentimes the dwelling, you're underinsured, even if you write the policy with accurate coverage. Maybe last year, this year, it's costing 15% more, 20% more to actually rebuild the home. Every insurance policy, most of the admitted policies, they have what's called inflation guard. And so every year that your insurance renews, it'll bump up that dwelling amount by 3 to 5%. But right now, literally in the last 2 to 3 years, you more likely need like a 10% to 15% rate increase, dwelling increase, to stay in line with appropriate coverage. So again, we've got this script, and it's very easy to communicate. Hey, take a look at your policy. If you're in a tract home, you should have a minimum of $300 a square foot. If you're in a custom built home, look at 500 or more. And again, Josh is going to be able to share that with you, and it's incredibly valuable to make sure that they've got proper coverage. Make sure they're not underinsured. The last tip is just a cost saving tip, right? We're all feeling this cost increase. I talked about how we're going to see more cost increases over the next year. And a very easy lever that we can pull as consumers, that we should pull to lower the cost, is increasing our deductible on our home insurance, right? So we recommend 5,000 to 10,000 for home insurance. And so the higher the deductible is on the home insurance, the lower the cost. But way more important than that discount, than that savings, is the positioning, right? The posturing. It's basically showing these insurance companies, hey, I'm going to be a responsible homeowner. Anything under $5,000 or $10,000, I'm going to pay out of pocket to fix myself, and I'm only going to leverage that home insurance for catastrophic losses, like a fire, or if someone slips in my driveway and tries to sue me, that's when I'm going to file a claim. Basically you want to use that get out of jail free card for catastrophic losses. And historically people would file claims for sub $5,000, and the insurance company would pay out $2,500, and then your insurance would go up, right? Because just like your driving record, if you get a ticket, costs go up. And again, it's just a practical positioning tool. It's kind of like life insurance. If you've got a family, it's something that you need to have, but you hope to God you never have to use. That's how we need to be viewing home insurance moving forward. And again, by adjusting that deductible, you're going to be able to take advantage of a significant savings discount. So with that, I'm going to go ahead and open up to any questions.
And real quick, Carlo. So number one, thank you so much. That's phenomenal. The information's fantastic. I had a couple quick takeaways. Number one, glad there's resolution in sight, right? Not that everything's just going to dramatically drop in cost, but at least there's a plan in place, or they're working towards putting a plan in place. So that's huge. That's great information we can pass along to our clients. Great education points I thought were the fact that California living is a first class type of community. It just is. Like, I've traveled to a bunch of different states, and even though they're great, little things like produce. This is something my wife and I like, getting fresh fruit and fresh vegetables at the store anytime you want. We go to Utah quite a bit, and their produce sucks. It really does. Like, you go to the store and like, what's going on with Utah produce? It's because it all comes from California, and they get like the secondhand produce. They just do. So that's a great sales point or education point to give to clients. I love that one. Quick comparison on the California is a mid-range state even today when it comes to cost insurance. We have a loan going right now for someone in Florida, middle of the state, normal single family home. They're paying $615 a month for insurance on a $500,000 home, and it's double their property taxes, right? So that's crazy. And then in Texas, another one. This is Dallas Fort Worth. We're doing a loan right now. Normal tract home, nothing crazy at all, not a fire zone, not a fire hazard zone. He's paying $468 for normal insurance, just normal insurance. That's it, right? So big comparison compared to California. Obviously, our prices are higher, but those states, especially Texas, the property taxes are double California, right? And then I'm going to start making my final call. I'm doing a video for all the clients that we close, letting them know that if their home is transferred to a new mortgage servicing company, they got to call and get that mortgagee clause updated. That's a big deal. That's a great education point for all of our clients. And then the takeaways when educating clients, remember how you react to things is how your clients will take the information. So if you're saying, oh, insurance is horrible, it's impossible, well, that's what they're going to think. But insurance is absolutely possible in the state of California. And most of the time, it's priced out really well. It's just that if it's going to be in a fire zone, a high fire area, then that's where they're really going to experience a higher cost. And I guess the first question of this would be, Carlo, is there a map or something that we can go to, a website that we can go to that you look at as an insurance broker that'll tell you if the home is in a high fire zone that will absolutely require California Fair Plan or not?
Yeah, short answer is no. There's no like tool that we can use, only because every insurance company, they underwrite independently, right? And so to backtrack, and then I want to expand on that fire mapping question is you're right. California, first class state, we're always going to be in vogue. There's always going to be a demand for people wanting to live in California. So yes, as real estate professionals, be optimistic about that, right?
Yeah.
And we are headed towards stabilization, and things happen, right? In every state, right? And so again, the elements, the pieces of the puzzle for it to improve are here, right? They passed that in January. So it's just going to take some traction, some time. And when we see these insurance companies come back, that stabilization will occur. But yeah, absolutely optimistic. In terms of the fire mapping, it's difficult. Like I said, every insurance company operates independently. And so I hear a lot of times realtors say, my NHD report is showing that it's not in a fire area, and they don't communicate, right? NHD versus like insurance companies, they're not on the same wavelength. And again, the perspective is insurance companies, they don't want to sell. They're trying to decrease, right, their footprint in the state until things improve. And so again, this is why it's really hard to just use generalizations, right? Especially with quotes, because there's so many factors, right? In addition to the location of the home, you've got like the square foot, you've got like prior claims on the home that are now significantly affecting eligibility and cost. You've got pets. I mean, there's just a myriad of elements. What I can say is if you're a real estate professional, use us, leverage the Old Harbor team. We want to be a trusted resource. You can get all of our contact information from Josh. And if you have a client, I am very good. God has blessed me with many talents, and one of them is the ability to tactfully communicate optimistically and walk these clients off the cliff, right? If they're going like, oh, I don't want to do this, there's not going to be an option. What if I get canceled and then won't be able to get home insurance? It's like, there's always going to be an option, right? There is guaranteed coverage, and it's just a matter of tactfully communicating that very clearly and transparently, right? So yeah, again, there's no like smoking silver bullet option. It's just a matter of being proactive on every transaction.
Yeah, cool. I think we got time for 3 questions. Anybody want to ask a question really quick?
Carlo, looking at it from the listing standpoint, if we have like an older home, I know roof and electrical panel issues are an issue. Is there a way to get like an estimated cost for a new buyer to come in to have that home insured so we know before going on market?
That's a pretty big thing. I would say again, get my contact information from Josh and reach out to me personally, and I can work with you on that. The term prior to kind of this crisis really took off was like a potential buyer quote, is what some agents call it. Oh, can I get a potential buyer quote? But again, there's just so many variables, right? Because you could say like, yeah, it's a home built in like the 50s or the 60s, and the electric hasn't been updated, and we have a handful of companies that would be open to insuring it. But then there's so many other variables, right? Like the buyer, and like it could literally, and we've had this happen where the potential buyer quote was one price, but the actual quote rendered the buyer ineligible because they didn't qualify for financing, right? And so you kind of get yourself in a position, but I think it's good to be proactive Aaron. And so reach out to me direct because you want to know that there are at least options, right? Like, okay, do we have options, right? Is there, do we have many options? What does it look like, right? And then, you know, even to have us as a resource, if you do have an open house and say, hey, you know, don't, if you have any questions, call Carlo at Old Harbor. They'll be able to spin up a quote for you guys quick. That's another one of our strengths is that in addition to being broad and being effective and having solutions, is that we're quick. Our company was designed literally to walk in lockstep with the real estate transaction. So and most times quote requests are back in under 2 hours. And if not, we communicate. We've got lots of videos that explain home insurance to buyers, explain condo insurance for buyers. So yeah, again, Aaron, I invite you to build a relationship. I want to earn your trust. And yeah, again, there's no like specific answer for that.
That is a great idea. If you're going into a listing and you know it could be a potential for fire insurance, having that at the ready is a big deal. That's huge. Cool.
I,
All
I
right,
have
couple
I have
more.
I have a ton of realtors, a ton of listing realtors are like, hey, I'm taking a listing appointment. What does this look like? What do you give me your perspective? And I'll quarterback like, you know, texting with them. And then once they get locked in, then we work on securing more tangible options. So yes.
Cool. Anybody else? No? Okay. Awesome.
I know that was a ton of information that I downloaded on all of you. And so I'm not expecting y'all to retain it, but just remember that you've got a trusted partner, right? In us and myself and Old Harbor. So if you ever need us to communicate some of these elements to a client or to your team, feel free to reach out. Thanks for your time.
Yeah. Thank you so much, Carlo. Appreciate it. You guys, I hope you got something great out of this. Call me, text me, or my team if you guys need anything at all. Always happy to help out. Carlo, thank you so much for your time, buddy. Really appreciate you.
You've got the script. You can email that out to your team, to your audience. And again, that script is invaluable. It's such a key tool. I've had realtors literally after this presentation within the hour go on Instagram and create a video of a listing and just talk the audio over it. And it's added a ton of value. So yeah, call me if you need me. Thank you guys. Have a great week.
Awesome. Thank you all. All the best to you. Thank you. Bye-bye.